Welcome to Trendlines Over Headlines, our new show where we'll be breaking down the markets with some of the best technicians in the world. My name is Patrick Denawilla and I'll be your host. We've got a great show planned for you today. Shannon will be joining us. A lot of you might already know him, but if you don't, Brian is a highly respected trader, author, and technical analyst. He's known for his work on the VWAP indicator, which has become one of my favorite indicators out there. So we'll definitely be talking to him about that. But before we talk to Brian, it is Friday, the markets are closed, so let's go take a quick look at how things fared this week. So the S&P 500 ended the week down just over 2%. We're still about 2% above the June lows, but we're still in a downtrend and there's a lot of technical damage, so it wouldn't be surprising to see us test those June lows in the near term. Now, the Russell 2000, you guys know I like to look at this one for a better idea of what the average stock is doing. And right now it looks even worse than the S&P 500. You can see it's kind of still flirting with those 2018, 2020 highs, but it certainly feels heavy. And again, a test of those June lows wouldn't be surprising. Now, joining us to talk about all this is Shannon. Brian, thank you for joining us today, especially ahead of the long holiday weekend like this in the summer.
Yeah, thanks for having me on, Patrick. Always good to talk to you.
Yeah, so I really wanted to bring you on to talk about VWAP. It's become one of my favorite indicators, and it's been such an important one to watch throughout the sell-off this year. I think it was the Russell 2000 first that tested its COVID VWAP. That's the one I'm really talking about, is that VWAP from the COVID lows. And so the Russell 2000 tested it way back in January, and it initially held. Like it successfully tested it a couple times early in the year, and then it sliced through it in April along with the NASDAQ. So, you know, NASDAQ and Russell have been the weakest, and they lost their COVID VWAP back in April. And then, you know, you can see it was just a straight trip down to the 2018 VWAP for the Russell 2000. And then it couldn't get back above. It tried, but it rolled over right at that COVID VWAP. So, and then you started to see the larger cap indices like the S&P 500 and the Dow also rolling over. And, you know, S&P 500 just broke its VWAP from the COVID lows a few weeks ago. And, you know, seeing the Russell 2000 and the NASDAQ testing their VWAP from the 2018 low, it's actually below it. It begs the question, you know, is the S&P 500 next? But I guess what I'm really saying is this indicator has coincided with so many major turning points in the major indices this year. So in your words, what is the VWAP?
Yeah, well, you know, on that Russell 2000, for instance, as you mentioned, we bounced from it almost to the penny in January, and then again in February. And then we kind of danced around on it and decisively broke through it in, I think, May. We then came up and touched it from underneath in June, and then we just got this most recent, you know, waterfall decline. But what the volume weighted average price is, traditionally, when it was first invented back in 1998, I believe was the year, was a tool for price execution. So a large fund would want to buy 1 million shares of whatever stock that day. They would want to buy 1 million shares of Amazon. So they would say, you know, they would go to their broker, let's say Goldman Sachs, and say, we want 1 million shares of Amazon today. And the brokerage would say, okay, well, you know, the stock is, let's say 600. It's not there today, of course. They'd say, okay, we'll buy those shares for you today. We will give you a guaranteed volume weighted average price. Or actually back then, it really wasn't even a lot of the institutions didn't know about it yet, that if the average price the stock traded at that day was, you know, 600. The low was 570 and the high was 620. Let's say Goldman Sachs was able to purchase those shares at 590 and they guaranteed a VWAP order at 600. Well, Goldman would be able to make $10 per share extra for doing it. But what the institution would say is, you know, compared to what they call it was the naive participant, the volume weighted average price, how did my order get executed? Did I do better? Did I do worse? Is it costing my shareholders? So the best way, Patrick, I tell people to explain it, and maybe I should have started here, is similar to a dollar cost average. If you go in and buy $1,000 worth of Apple each month, some months you're going to buy 100 shares, some months you're going to buy 85 shares, or you might have 145 shares if the stock really gets hit hard. But you're always buying $1,000 worth. That's the constant. So your volume of money is a constant, not your shares. So it's adjusted for the price. So at the end of the year, you have 12 purchases. You might have made 83 shares one month, 123, 57 shares if it really rallied hard. And at the end of the year, the accountant would say, what was your average price? My average price purchased is, like $12,000 worth. Each volume weighted average, dollar cost average, is basically your volume weighted average price that you need to report to the IRS to get your cost basis. So, it's kind of morphed with a lot of my help, I think, to an analysis tool and anchoring it to a specific spot. Like you said, the COVID volume weighted average price has been very important for not only the indexes, but a ton of stocks and just, all these other levels that we can discuss as well.
Yeah, I mean, so I've heard you describe it this way before, as basically the average price that buyers and sellers have transacted at since a specific date. Is that correct?
Yes.
So yeah, is it fair to say when you see the S&P 500 below its COVID VWAP, is it fair to say that the average buyer since the COVID low is now underwater? Is that kind of how you look at it, or is that kind of a too simplistic way?
No, I think that's the beauty of this, is it is simple, and it allows us to tell with absolute certainty that the average participant, adjusted for the volume, is losing money. The average short since that event is making money. So it tells us with absolute certainty who's in control from any point that we choose to start our anchor. Now we can start our anchor, December 18th of 2020. It wouldn't mean anything. It has to be from a significant event where there's other people looking at this and saying, why is that date important? Well, because that's where we had our washout low. So in a way, you can think of it as a sentiment tool. But unlike all the sentiment tools out there that are based on opinions and, opinions and new headlines or, what people call on Twitter and just what people are talking about, this is the actual dollar cost average, the volume weighted average price from any event. So it tells us the truth about sentiment, not what people are saying, because we know they're often quite different.
Yeah, I mean, you say it helps you tune out noise, and I can't tell you how many times this year my opinions basically come down to, if it's below this COVID VWAP, then there's caution warranted and stuff like that, and it does help you just simplify things, right? If we're above it, great. It's okay to take some shots at longs, but if we're below it, caution's warranted, kind of thing. And I love how you describe it. What is it that you always say? The trend is innocent until proven guilty, or
guilty until proven innocent. Right now, we're in the downtrend. So the weight of evidence, the proof, the burden of proof is on the bulls right now. It's guilty till proven innocent. When we're in an uptrend, it's innocent till proven guilty. You look at pullbacks and you say they have a higher likelihood of continuing to the upside in an uptrend, whereas the rallies in the downtrend, we want to treat them with a high level of suspicion because the primary trend is lower. They're guilty till proven innocent. So we can trade these little bounces, but they're bounces until the market undergoes that accumulation and then starts to begin a new bullish phase where it's above all the moving averages. It's above the key volume weighted average price, where we can, I'll identify a low 6 months after the low is made, maybe. And it doesn't matter. The point is, we want to be involved when the buyers take control and use those shorter term timeframes to look for the evidence, so that if you're a day trader, and it's below the daily volume weighted average price, your bias should be to the short side. If you're a day trader and let's see, you're an S&P trader, it pulls back to a rising volume weighted average price during the day, you want to look at that point and say, now I want to see if the buyers are gaining control, because if it starts to rally away from this volume weighted average price, I can get involved, participate in this trend, and then set my stop under that most recent relevant high or low, even on a 1 minute time frame. But the beauty, as you know, of technical analysis is the fractal nature. What occurs on one time frame is directly related to any other time frame.
Yeah, kind of looking at it in multiple time frames and seeing that relationship play out. But let's take a look at some of these charts that you brought along. I know we're looking at similar VWAPs there. The 2018. This is the S&P 500, correct?
I don't see it, but yes.
So you have the VWAP from the 2018 low there in purple, and I believe that's around 3,500 in the index, 350 in SPY. And we've kind of been flirting with that VWAP from the COVID low, but we can't seem to get above it. So like you said, kind of guilty until proven innocent. But walk us through that one. You got 3 VWAPs on here.
Right, I've got the red one, which is the year to date, which actually happens to be pretty close to the all-time high.
Don't you love that it lined up just like that?
It is pretty cool. And then, of course, the orange is from the COVID low, and below that is the purple one. The purple one is from the 2019 low, and you can see how that had been important through 2019. Then we had until COVID, the initial move came down and looked like maybe it was going to hold there, but then we saw the water fall down through that. So that 350 level now is where I think it's the next stop. We have, when you look at this, it's a clear pattern of lower highs and lower lows, and it's just kind of distributing before the next leg lower down towards that 350 level is how I'm viewing it.
Yeah, and around that 350 level too, it's not just that VWAP from the 2018 or 2019 low. It's there's some other things going on there too. I think you have the 200-week moving average around 350, and also a Fibonacci level. Isn't that right?
Yeah. So we have a confluence of indicators that tell us that's that there's other people viewing that as an important level in the market. So we've got, as we know, the volume weighted average price from the 2018 low. I remember that low. It was right around that Christmas, New Year's.
I remember that. It was a dark Christmas, yeah.
It was a dark Christmas. And a great rally emerged from there. In these rallies, I'm just going to go on a tangent. The last 2 big rallies off those powerful lows came when we had, an easing monetary policy, easy money, zero interest rate policy. This time,
a lot different environment now. Right.
So a lot of people are still looking for this V bottom. I think it's going to take more time. So the next stop, seems likely that one, we have, as we noted, the volume weighted average price from the 2018 low. We have the 200-week simple moving average. And you look at that chart, they're just right on top of each other. So, that tends to be, as you can see in 2019, that low bounced perfectly from the 200-week moving average. There are people who look at that and say, I'm not going to sell short. I'm going to cover there. I'm going to start to buy longs for my long-only account. Well, now it's always the psychology of what we see there. It's not just that we have a 200-week moving average, but if we get down there, we will have dropped from 480 to 350. That's a pretty nice drop, and we'll have participants who are saying, I'm going to cover shorts. That's my target because it's the 200-day moving average. Shorts are going to cover because it's the volume-weighted average price from 2018 low. Other shorts are going to come to the same conclusion and say, I'm going to cover some shorts because it's the 50% retracement. And if you go back to the late third quarter and fourth quarter of 2020, you can see that was also a level of resistance. Resistance broken tends to act as support. So we have all these, now we have 4 things coming together in the same spot that says this is an important level that different groups are going to be coming together and forming the same conclusion that, hey, it's down too much, I'm going to stop shorting. Hey, I've been a little bit aggressive on the short side, I'm going to start to cover. People have been sitting on the sidelines, disciplined people have been sitting on the sidelines. They're saying, maybe I'll add a little bit. But we know that institution word gets misused. It's just kind of like saying retail is the dumb money and institution is the smart money. And we can all point to thousands of examples. I mean, 95% of the money managers out there fail to beat the S&P 500. We could pick on Kathy and say, is that smart money? It doesn't look like smart money to me. So institution doesn't mean smart money. But in a lot of the mutual funds are mandated; they have to be 90% invested. The best they can have is 10%, maybe even 5% cash. So they have to be in the market. Whereas the smarter, really smart money, the hedge fund money who's been shorting this will start to say, this looks like a logical spot because prior resistance becomes support. We've got the 50% retracement. We've got the 200-week moving average. We've got that important volume weighted average price. So they all come together, and it's that equilibrium point where it has the potential to become support.
Yeah, I like what you're saying there. I think instead of calling institutions the smart money, maybe we just call it the disciplined money, or not institutions, but maybe we call it the disciplined money. Yeah.
Yeah, the smart money could be you or me. It's hopefully it's you and me, and it could be anyone listening to this. The point is, we all have an advantage, I think, over the mutual fund that has to be 95% long committed. You don't have to have that. You can look at this market objectively and say, you can't just say, oh, good, I'm down, less than the rest of the market. That's loser mentality. My mentality is, I want to be up. I want to be making money. The object of this game isn't to lose less than the average. It's to be better than the average. It's to make money. It's to win and to think about my performance, not about what everyone else is doing.
Yeah. So on this one, I mean, basically, as long as we're below that orange COVID VWAP, you got to have your eyes on 350. And if we break it, maybe the year-to-date VWAP from the peak comes into play. Maybe that's one to keep an eye on.
That's pretty high up there, but sure, yeah. I mean, we've had some big rallies this year. 12%, a couple, 8-9% rallies. So, but again, the sum of the declines is greater than the sum of the rallies. So, more opportunities on the downside right now.
Yeah. And semiconductors too. That one got a lot of buzz this week. On a relative basis, it hit new 52-week lows. And that's such an economically sensitive and important area. And seeing weakness in that industry group is definitely a red flag. But why don't you walk us through some of the levels you're watching on this one?
Yeah, it was a surprise to me that the semis lost 9% this week. That's a smash.
9%.
9%. They're down.
And
3%.
This is SMH.
SMH. They're down
Okay.
3% today, Friday. It was a big hit, and it was really astounding to me. I've been looking at the semis along with the Qs for the last 25 years, or not 25 years, because I don't think the SMH has been around that long, but we used to look at the stocks. But now, because the SMH is better to look at because there's volume, which means we can add volume weighted average price levels. We can't do that on the SOX because it doesn't trade. It's a made up thing. The SMH trades. That's why I use the ETF, the most liquid ETF, to use the analysis on these sectors. But 9% in a week, and the and then the Nasdaq was down. It was still a bad week. It was down 4%. But usually the semiconductors lead the Nasdaq, and then if they're down 9%, you would expect the rest of the Nasdaq to get dragged down with it. And then as the Nasdaq gets dragged down further, it takes the rest of the market, the S&P, and that sort of thing. So this S&P is more sensitive to energy and banks, but technology, of course, in the Nasdaq. Anyways, I'm going off on a tangent there. In this semiconductor index, we decisively broke below that COVID volume weighted average price about 4 weeks ago at about 225. It was kind of dancing on it there. We smashed down through it. This week we had follow through, and when you're looking at that chart, we've kind of got the same levels drawn in on that weekly, which are, again, the orange is the COVID, the green is the volume weighted average price from the December 18 low. That comes in right at about 182-ish. And just below that is the pink, which is the 200-week simple moving average. That comes in right around 180. So those two things, again, tell me maybe there's buyers there. Maybe the shorts are going to become less aggressive. That becomes a downward target for people who are short this. And it's not quite down 50% at that level, but it's really a large hit. If you take the COVID low and you measure the Fibonacci straight up to the all-time high, at 61.8% retracement comes in right exactly on that green volume weighted average price from the 2018 low.
That's the 61.8 retracement right there. Wow, really coincides with those two.
So it's crazy that, you look at that and say, that's clearly a level of interest. A lot of people will say that's support. We don't know if it's support. It might just slice right through them. We only know support after the fact. It's a potential level of support. But what gives us the potential? What is it that makes people decide, I'm going to stop shorting? I'm going to start nibbling on the long side, or I'm going to start covering my shorts. That's what's more important than saying, hey, it's 61.8% retracement. I read in a book somewhere that that's important. Why is it important to the market? It's important because people have been trained it's important. So they decide, I'm going to stop shorting there. I'm going to start to cover. Less supply, more demand. Sidelines says, hey, I'm going to start to put a little bit of money to work there. More demand. They were in cash. Now they're adding demand. It's all about supply and demand. What drives people's decisions to change their minds, whether it is, jump in off the sidelines from cash to put a bid in under that market and provide support? What provides the opportunity for a short to say, this is where I should be starting to cover? And as they start to cover and buyers start to form in that area, and there's less supply because the shorts are getting less aggressive, other people on the sidelines start to say, looks like this is becoming a level that's being defended. I'm going to bid for it. Hey, wait a minute, it's bouncing a little bit. I'm going to chase it. And we start to see that equilibrium in that area. And it doesn't mean it's just going to turn on a dime and head higher. Again, you have to look at the monetary policy says, it might take a long time. It might just be a resting stop on the way down to, who knows, 150 in these things. The trend is lower. It's guilty till proven innocent. These are levels of interest to look at shorter term timeframes to say, can we get a bounce in this area that's tradable? If we can trade that bounce and it continues to hold up, then I can transition what I thought was a short-term trade into something longer. And as it starts to rebuild, maybe add, because the bigger pictures are starting to look better, and maybe you catch a bottom by accident. But I'm not trying to pick a bottom in that area. It would always be a by accident if I were to buy the bottom.
Yeah. I've always loved how you describe support and resistance as potential levels of interest, because I think that's a really good way to think about these levels. There's no guarantee that there's support, there's bids there, or there's supply there. These levels can be broken, but they're potential levels of interest, and I don't think you can describe them any better than that. But let's finish up with crypto here. We broke a key level this week, yesterday. We broke under that $19,000, $20,000 level, and that was the 2017 highs. So that was a really important level. Basically, all the gains got erased on the last crypto bull market, or they have been erased. So what are some of the levels you're watching?
At
lower. I mean, just lower. The momentum's to the downside. There's really, you can draw an anchored VWAP that actually goes back to, I'm just trying to look at it on my screen up there, so darting away from my eyes away and looking like I'm not interested. But there's a volume weighted average price that measures from kind of an important breakout in 2017 at about the 1200 level. And we're testing that this week, so that volume weighted average price. So maybe we stabilize in here, but when you look to that other chart, I've sent you that daily chart, which is just the year to date volume weighted average price and the VWAP off the high. We're down close to 60% year to date in Bitcoin. And I saw another brokerage is saying they're not, allowing withdrawals again. So
yeah, I saw that.
Just the week the low we saw 2 weeks ago, it looked like, again, the buyers emerged at that 17.5 level. As it got to about 18.5, it put a volume weighted average price on that low. No one knows where it is, but once we start to move away from it, you can say that looks like an important low. And then, 2-3 weeks later, on June 22nd, we came down and tested the volume weighted average price from that low. So you could buy a break above that and you start raising your stops. But then as it broke back below that volume weighted average price from the prior low on June 28th, we had a kind of a little waterfall from there. Yesterday, we had a little suckers rally right up to that volume weighted average price. So, no matter what time frame you look at, it's still broken. It's guilty till proven innocent. It's got major problems. It's just I don't see why you would want to buy it unless you think that it's, the way of the future, whatever people, convince
It's an
themselves to
inflation
buy
hedge.
things. Right. Yeah. I got a lot of shit for that one this week. And I posted, that's not even inflation. Okay. Well, the people who, whatever. Nothing's an inflation hedge. As I say, in a bear market, the correlations go to 1. Everything gets hit. This happens to be getting hit worse, and they'll say, well, go back 10 years. Well, there was no inflation 10 years ago. When inflation started ramping up last May, that's when Bitcoin peaked, and it's been a sell-off since then. So I don't care about those academic debates. Actually, I thought hard when I pressed the button on that tweet. I was thinking, you know what? Some people are gonna just give me all these stupid reasons why I'm wrong, and I don't
even know what the tweet is you're referring to, but that's obviously the conversation right now. Is it's definitely not an inflation hedge.
I put the CPI month by month and overlaid.
Oh, that's right.
Bitcoin monthly.
Yep, I did see that.
Yeah, I think actually you posted it on the chart report.
I think it's a very valid point, though. I mean, for anybody who is, I'm sure there is applications for Bitcoin and everything, but let's not fool ourselves and pretend that it's something that it's not. And I think your chart there, I'll throw it up, did a great job of actually illustrating that point. But Brian,
the bottom line is I don't even care. I really don't. It's an academic debate, and I'm not an academic. I'm a trader. So, if it's going down, I'm not going to buy it. It's just as simple as that. I don't believe it's going to save the world. I don't believe all this stuff. If you believe that and you can withstand 60% drawdowns and still feel comfortable, you've got a different risk profile, different time frame than I do. Good luck. I sincerely mean that. I'm not saying it as a wise ass thing, but it's just not me. And we have to understand who we are and what our time frame is in the market based around our risk tolerances and our belief system.
Yeah, well, that's the beauty about the way that you and I look at the markets through like a technical lens is we can trust the trend lines over the headlines. We don't have to get into those academic debates and all that, But
Only
real
price
quick,
pays, I'd have to say that, right?
Yes, that's true. So you have a new book coming out soon, right? Relatively soon, but it's in the works.
End of the year, yeah. I turned in my first draft and it's working on edits and that, but with the whole supply chain thing, there's a big backlog for when I can get it printed and all that. So I'm going to try some creative workarounds on that. Let's just say.
Yeah. Well, I got a copy of your other book, Technical Analysis in Multiple Timeframes, that I need to get you to sign it sometime.
Absolutely. Next time we see it at a conference or something.
Well, I can't wait. Thank you so much, by the way, for joining us today and sharing your charts and your thoughts.
My pleasure, Patrick.
All right. Thank you. Have a great weekend.
You too. Bye.
Bye. Well, hey, thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Have a great long weekend. Thanks.